MicroStrategy just dropped a bombshell. The company is launching a brand new financial product called Strife, designed to raise even more capital to buy Bitcoin. Since 2020, Michael Saylor has turned MicroStrategy from a software company into one of the biggest Bitcoin whales in the world, holding 500,000 Bitcoin, and now they're doubling down again. But not everyone is convinced. Some say it's a masterclass. Others think it's dangerously over-leveraged and could even pose risks to the broader crypto market. So, what exactly is Strife? How does it fit into MicroStrategy's overall plan? And why is it stirring up so much debate? By the way, if you're new here, my name is Danilo, and I break down complex crypto topics to help you stay ahead in the space. If that sounds interesting to you, make sure to hit that subscribe button and ring the notification bell so you never miss future crypto updates. Alright, let's get into it. Let's zoom in on exactly how MicroStrategy pulled this off. It all started in August 2020, when they made their first big Bitcoin purchase, 250 million worth. But that was just the beginning. They quickly developed a playbook, using financial tools like convertible bonds, stock offerings, and preferred shares to consistently raise fresh capital and funnel it into more Bitcoin. Over time, this strategy transformed MicroStrategy from a traditional software company into what many see now as a Bitcoin holding vehicle. Today, they've accumulated 500,000 Bitcoin, roughly 2% of the total circulating supply. And behind that number is years of creating financial structuring designed to maximize Bitcoin exposure without touching their core business revenues. What's interesting is how they financed this entire approach. It's not coming from their software business profits. It's all been fueled by issuing different financial products, each tailored to appeal to a specific type of investor. Whether it's those seeking high upside, let's say, predictable income, or lower volatility exposure, there's really something for everyone. First, you have common stock with no dividend and high risk. Then came the Strike preferred shares, offering an 8% dividend and the ability to convert into common stock. And now, Strife is the latest addition. The big question now is, how does Strife stack up compared to their previous offerings, and why is it drawing so much attention? Let's break it down. So, what exactly is Strife, and how does it differ from MicroStrategy's other financial products? Strife, ticker symbol STRF, is what's called a perpetual preferred stock. At its core, it offers investors a fixed 10% annual dividend, paid out in cash every quarter. But there's an interesting catch. If MicroStrategy ever skips a dividend payment, that dividend doesn't just disappear. Instead, it compounds quarterly at an additional 1% per quarter, all the way up to a maximum of 18% annually. On top of all that, each Strife share carries a $100 liquidation preference, meaning if MicroStrategy were ever to shut down or liquidate, Strife holders would get their money back before common stockholders. However, unlike their previous preferred stock offering, Strife comes without a conversion feature. You can't convert it into common shares if MicroStrategy's stock price skyrockets. So, you're trading off any additional upside potential in exchange for more predictable, steady income. It also doesn't come with any voting rights. This is purely a financial instrument for investors seeking yield and lower volatility exposure. The company expects Strife to be listed on the Nasdaq, with the first dividend payment set to start in June 2025. Now, the reason behind this launch is no surprise. MicroStrategy wants to continue raising capital without selling their Bitcoin, but this time, they're clearly targeting a different type of investor, those who prefer passive income and stability over Bitcoin's volatility. It's a product tailored more towards institutions, income funds, or investors looking for consistent returns without the roller coaster ride of common stocks or crypto itself. And on paper, Strife might sound like a win-win, but as we'll see in a moment, this product has sparked some serious debate about sustainability, risk, and whether MicroStrategy might be stretching itself too thin. Before we get into all of that though, let's compare Strife to their other offerings to see how it fits into the bigger picture. Now that we understand what Strife is, let's step back for a second and see how it compares to MicroStrategy's other offerings. At this point, they've built three distinct financial products, each with its own features, risks, and appeal. First, there's the classic MicroStrategy common stock, ticker MSTR. This is what most retail investors are familiar with. It doesn't pay a dividend, but it comes with full voting rights and gives investors the highest possible upside if Bitcoin's price soars. Of course, that upside comes with high volatility, since the stock tends to closely mirror Bitcoin's price movements. Then you have Strike, which was launched not too long ago. Strike is preferred stock, offering an 8% annual dividend. What makes it unique is that investors can choose to receive their dividend either in cash or in stock. Plus, there's a built-in conversion feature. Holders can convert their Strike shares into a MicroStrategy common stock at a certain price point, giving them some potential upside exposure if the stock performs well. And now we have Strife. And like Strike, it's preferred stock, but with a few key differences. Strife pays a higher fixed 10% annual dividend, and the dividend is only paid in cash. There's no conversion feature, meaning no exposure to MicroStrategy's common stock upside, and no voting rights. It's designed to appeal to investors looking for steady income, minimal volatility, and security in the form of that liquidation preference. In short, if you're an investor looking for the highest possible Bitcoin upside, common stock is the play. If you want a mix of income and potential stock conversion, Strike fits that middle ground. And if you're after predictable passive income without all that junky roller coaster ride, Strife is clearly designed with you in mind. But here's where it gets interesting. While on paper these products offer flexibility for different investor profiles, some analysts argue that layering all these financial instruments might come with hidden risks. And that's what we're going to dive into next. On paper, Strife seems like a smart addition, another tool in MicroStrategy's arsenal to raise capital and keep stacking Bitcoin. But it hasn't come without criticism, and a lot of people in both the crypto and traditional finance worlds are raising valid concerns. One of the biggest questions is simple. Where is MicroStrategy going to find the cash to pay these dividends? Strife commits them to paying 10% annually, which adds up to over $50 million a year if fully subscribed. But MicroStrategy isn't generating that kind of cash flow from their core software business. They're also not staking or lending out their Bitcoin to earn yield, and they certainly aren't planning to sell any of it. Critics worry that unless Bitcoin's price continues to climb and stays high, MicroStrategy might have to keep issuing more financial products just to cover these dividend obligations. It starts to feel like a financial juggling act, where the only way to keep things running smoothly is to keep bringing in fresh capital. Some are even comparing this to over-leveraged strategies we've seen fail in the past. Although, it's worth noting that MicroStrategy's stock price hasn't reacted negatively, suggesting that many investors still have confidence in Saylor's vision. There's also concern about the complexity and layering of all these different financial products. With common stock, Strike, and now Strife all on the table, it's creating a web of different shareholder priorities and obligations. While it may not seem like a problem today, skeptics argue that if market conditions shift, or if Bitcoin enters an extended bear cycle, this structure could become more fragile than it appears. Some analysts have gone as far as to suggest that MicroStrategy is walking a fine line, and that one misstep could have broader implications not just for the company, but potentially for Bitcoin's price and sentiment overall. Now, to be fair, Saylor and his team clearly have some kind of strategy, but whether this is brilliant financial engineering or pushing the limits too far depends heavily on how the next few months play out. Next, let's explore why some people see genius behind this move and how it ties into a much bigger picture narrative about Bitcoin adoption. While critics are quick to highlight all the risks, there's also a strong case to be made that Michael Saylor knows exactly what he's doing, and that Strife is yet another calculated move in a long-term strategy. At its core, Saylor's thesis hasn't changed. He believes Bitcoin is the ultimate store of value, digital property that will outperform cash, bonds, and even stocks over the long term. Every financial product MicroStrategy has launched is designed to accumulate more Bitcoin without ever having to sell the Bitcoin they already hold. Strife fits neatly into that approach. By offering investors a predictable, fixed income product, MicroStrategy is tapping into a whole new pool of capital, particularly from institutions and funds that may not be comfortable holding volatile crypto assets outright. Another key point, often overlooked, is timing. We're in an environment where interest rates are likely to peak or even decline in the near future. If liquidity loosens up, capital becomes cheaper, and Bitcoin continues its upward trajectory, locking in capital commitments at a 10% fixed rate could turn out to be a very smart play. And beyond the financial engineering, there's a broader narrative here: Bitcoin as a geopolitical asset. Some analysts frame this as part of a nation-state level game. The United States reportedly holds around 198,000 Bitcoin. China is rumored to hold about 190,000. MicroStrategy, with about 500,000 Bitcoin on its books, essentially acts as a pseudo-state actor, an American entity accumulating Bitcoin aggressively. From this perspective, Saylor's moves aren't just about MicroStrategy. They're about positioning Bitcoin as a core financial asset, both for corporations and, indirectly, for national economies. And if he's right, Strife could be seen not as an overreach, but as another lever to pull in this race to acquire as much Bitcoin as possible before others catch up. That said, all this depends on Bitcoin continuing to perform, and the bigger their position grows, the higher the stakes become. Next, let's talk about what could go wrong and why some are still uneasy about MicroStrategy's strategy. Of course, no strategy is bulletproof, and it's worth looking at what could go wrong with MicroStrategy's current approach, especially now that they've layered products like Strife on top of their existing structure. The most immediate risk is pretty straightforward, I'd say. What happens if Bitcoin enters a prolonged bear market? MicroStrategy's strategy depends heavily on Bitcoin's price holding strong or trending upwards. But if Bitcoin stalls out or faces significant downwards pressure, the company could be left with mounting dividend obligations, over $50 million a year from Strife alone, without a clear source of income to cover it. They've made it clear that they won't sell their Bitcoin, and their software business alone isn't generating enough free cash flow to absorb those payments. In that scenario, MicroStrategy might have to issue even more debt or stock, potentially diluting shareholders or increasing financial pressure. Another factor is regulatory risk. As MicroStrategy continues to innovate and build increasingly complex financial instruments, it's not unreasonable to think regulators might take a closer look. Especially with governments and institutions now eyeing Bitcoin more seriously, there's always a chance that new compliance hurdles or financial disclosure regulations could come into play. And lastly, there's market sentiment itself. If investor confidence starts to crack little by little, whether due to macroeconomic shocks, rising interest rates, or unexpected Bitcoin volatility, it might get harder for MicroStrategy to continue raising capital through these kinds of offerings. When things are bullish, financial engineering looks incredibly smart. But in tighter, risk-off environments, structures like Strife can quickly become liabilities if market appetite dries up. That's not to say any of these risks are imminent, but they're worth keeping in mind when evaluating how sustainable this strategy really is. Let's bring it all together. MicroStrategy's new Strife offering is another bold move in their ongoing strategy to accumulate as much Bitcoin as possible. It's designed to appeal to investors looking for steady, predictable income without the volatility of crypto itself. On one hand, it's a clever way to tap into fresh capital while holding onto their Bitcoin stack. And on the other, it raises some serious real questions about sustainability, risk, and whether financial engineering like this can withstand tougher market conditions. At the end of the day, whether you see this as a genius move or a potential overextension depends on how you view Bitcoin's future and how comfortable you are with the level of risk MicroStrategy is taking on. Personally, I think it's one of the most fascinating strategies we've seen unfold in real time, especially as corporate and institutional players continue to shape the Bitcoin landscape. But now, I want to hear from you. Do you think MicroStrategy is playing it smart, or are they walking a fine line? Drop your thoughts in the comments. I'd love to get your opinion. And if you found this breakdown helpful, make sure to hit that like button, subscribe, and ring the notification bell so you don't miss any future crypto updates. Thanks for watching, and I'll see you in the next one.